Welcome to Spotlight Knowledge. I am Jennifer. Today's spotlight is on the difference between investing and speculating and 10 investing rules. In today's market, the majority of participants are simply chasing momentum for performance. Is this speculating or investing? Motivation is a test for determining the difference between investment and speculation. Speculators focus on prices. Investors focus on the fundamentals of the business. Speculators buy or sell securities or commodities in order to profit from price volatility. For example, they buy gold on Monday and expect to sell it on Wednesday for a pile of profit. Investors do thorough fundamental analysis first to ensure safety of principal and a good return before buying or selling stocks or commodities. Chasing market is a purest form of speculating. It is simply a bet on prices going higher rather than determining if those assets are selling at a discount to fair value. For the rest of the time, I'm going to talk about 10 investing rules. We will learn a lot from the legendary investors. The first rule is about diversification. The trick is to take risks and be paid for taking those risks, but to take a diversified basket of risks in a portfolio. Diversification is a common strategy in investing. Great investors focus on risk management because risk is not a function of how much money you will make, but how much money you will lose when you are wrong. In investing or gambling, you can only play as long as you have capital. If you lose too much capital because of taking on excessive risk, you can no longer play the game. Be greedy when others are fearful, and be fearful when others are greedy. One of the best times to invest is when uncertainty is the greatest and fear is the highest. The second rule is the biggest mistake investors make is to believe that what happened in the recent past is likely to persist. They assume that something that was a good investment in the recent past is still a good investment. Typically, high past returns simply imply that an asset has become more expensive and is a poorer, not better investment. Nothing good or bad goes on forever. The mistake that investors repeatedly make is thinking this time is different. The reality is that despite central bank interventions or other artificial inputs, business and economic cycles cannot be easily repeated. Ultimately, what goes up must and will come down. Wall Street wants you to be fully invested all the time because that is how they generate fees. However, as an investor, it is very important to remember that price is what you pay and value is what you get. Eventually, great companies will trade at an attractive price. Until then, wait patiently. The third rule is most investors are primarily oriented toward returns, how much they can make and pay little attention to risk, how much they can lose. Investor behavior driven by cognitive biases is the biggest risk in investing. Greed and fear dominated the investment cycle of investors, which leads ultimately to buying high and selling low. The fourth rule is you don't get rewarded for taking risk. You get rewarded for buying cheap assets. And if the assets you bought got pushed up in price simply because they were risky, then you are not going to be rewarded for taking a risk. You are going to be punished for it. Successful investors avoid risk at all costs, even it means underperforming in the short term. The reason is that while the media and Wall Street have you focused on chasing market returns in the short term, ultimately the excessive risk built into your portfolio will lead to extremely poor long-term returns. Chasing financial markets higher will eventually lead you over the edge of a cliff. The fifth rule is about human emotions. The speculators' deadly enemy are ignorance, greed, fear, and hope. All the statute books in the world and all the rule books on all the exchanges of the earth cannot eliminate these from the human animal. Allowing emotions to rule your investment strategy is and always has been a recipe for disaster. All great investors follow a strict diet for discipline, strategy, and risk management. The emotional mistake shows up in the returns of individual portfolios. Now let's move on to Rule 6. Rule number 1. Most things will prove to be cyclical. Rule number 2. Some of the greatest opportunities for gain and loss come when other people forget rule number 1. The realization that nothing lasts forever is critically important to long-term investing. In order to buy low, one must have first sold high. Understanding that all things are cyclical suggests that after long price increases, investment become more easily to decline than further advances. Now let's look at Rule 7. The biggest investing errors come not from factors that are informational or analytical, but from those that are psychological. The biggest driver of long-term investment returns is the minimization of psychological investment mistakes. Buy when there is blood in the streets. This simply means that when other investors are panic selling, you should be the one to buy. Now let's take a look at Rule 8. Buy when the asset is cheap and sell when the asset gets expensive. Valuation is the primary determinant of long-term returns, and the closest thing we have to a law of gravity in finance. Cheap is when the asset is selling for less than its intrinsic value. Cheap is not a low price per share. Most of the time, when a stock has a very low price, it is priced there for a reason. However, a very high-priced stock can be cheap. Price per share is only part of the valuation determination, not the measure of value itself. Rule number 9 is from George Soros. It's not whether you are right or wrong that's important, but how much money you make when you are right, and how much you lose when you are wrong. Back to risk management, being right and making money is great when the markets are rising. However, rising markets tend to mask investment risk that is quickly revealed during market declines. If you fail to manage the risk in your portfolio and give up all of your previous gains, then you lose the investment gain. Regression to the mean is the most powerful law in financial physics. Periods of above average performance are inevitably followed by below average returns, and bad times inevitably set the stage for surprisingly good performance. The chart is the 3-year average of annual inflation-adjusted returns of S&P 500 going back to 1900. The power of regression is clearly seen. Historically, when returns have exceeded 10%, it intended to fall to 10% below the long-term mean, which destroy much of investors' capital. Market timing is not an effective method of managing your money. Great investors throughout history have had one core philosophy in common: managing investing risk to conserve and preserve capital along the way. You will win eventually. Speculators don't manage risk properly. If they run out of chips, they are out of the game. That's all for today. Thanks for watching. Hope you can join me again for the next Spotlight program. Bye-bye.